October 15th, 1929. Irving Fisher, Yale professor, most famous economist in America, the man millions of ordinary people trusted with their financial worldview, stood up in front of a room full of stockbrokers in New York City and said with complete confidence, "Stocks have reached what looks like a permanently high plateau." 13 days later, the entire market collapsed. And here's the part that makes it perfect. Fisher wasn't just wrong as an economist. He was wrong as an investor. He had his entire $10 million fortune in the stock market, margined to the hilt, under-diversified, leveraged. He lost almost all of it. The man who told America the crash couldn't happen got crushed by the crash he couldn't see coming. But before we drag Irving Fisher for the next 20 minutes, let's be clear about something. This story isn't really about him. It's about something much bigger, much more uncomfortable. Because what Fisher said in that room in 1929 is the same thing someone is saying right now, today, somewhere, in a slightly different suit, with slightly different numbers, calling it something slightly different. This time is different. It never is. Let's go back to the late 1920s, because if you weren't watching carefully, it genuinely looked like humanity had figured it out. Between 1922 and 1929, the U.S. economy was doing things that, honestly, made people feel invincible. Gross national product growing at 4.7% a year. Industrial production climbing at 3.1% annually. Unemployment sitting at a comfortable 3.7%. The economy was booming around automobiles, electrical appliances, chemicals, the cutting-edge technology of the era. Consumer prices were falling slightly, down 1.1% annually between 1926 and 1929. U.S. nominal GDP hit $105 billion. Steel production? Record. Railroad revenues? Record. Retail sales? Record. And the Wall Street Journal, at the very start of 1929, published a statement that aged poorly. One cannot recall when a new year was ushered in with business conditions sounder than they are today. Sounder than today. Great. Fantastic. Thank you for that. Here's what was actually happening underneath all those record numbers. Since August 1921, the Dow Jones Industrial Average had increased sixfold, from 63 points to 381. In 8 years. And people weren't buying stocks with money they had. They were buying stocks with money they borrowed. In the 1920s, you could put down 10 to 20% to buy stocks and borrow the rest, a 10% margin requirement. By the summer of 1929, 300 million shares of stock, 300 million, were being carried on margin. People sold their Liberty bonds, they mortgaged their homes. Chauffeurs and cooks were buying securities alongside banking magnates because everyone knew prices only went up. That's not investing. That's a chain letter with a nicer outfit. And here's the thing about buying anything on 10% margin. If the price drops 10%, your entire investment is gone. And you still owe the loan. Every dollar of borrowing became a loaded gun pointed at the market's own head. And nobody wanted to be the one to say it. Well, almost nobody. On September 5th, 1929, a financial analyst named Roger Babson stood up at the annual National Business Conference and said, and I want you to appreciate how much courage or insanity this required. Sooner or later, a crash is coming, and it may be terrific. The market immediately dropped. It became known as the Babson break. And then the market recovered and rallied all the way back up. And what happened to Babson? He was mocked, dismissed, labeled a pessimist in a room full of optimists. Because the fundamental religion of the late 1920s was that smart people, real experts, understood that this era was different. The economy had genuinely transformed. New technologies, new productivity, new everything. 6 weeks later, the market collapsed. Babson was right. Nobody remembered Babson. What actually triggered the crash? The honest answer is several things, compressing together like a slow-motion car pileup that everyone saw coming and nobody stopped. August 8th, 1929, the Federal Reserve Bank of New York raised its discount rate from 5% to 6%. September 26th, the Bank of England raised its rate from 5.5% to 6.5%. England was hemorrhaging gold into the New York Stock Exchange and wanted American investors to come home. Both moves tightened credit. A tighter credit environment and a market built entirely on borrowed money are not friends. October 18th, the market started to break. Not a clean drop, a grinding, accelerating, increasingly panicked descent. October 24th, Black Thursday. A record 12.9 million shares traded in a single day as investors tried to get out. The Dow was already 21% off its September peak. A consortium of major banks, we're talking the most powerful financial institutions in the country, pooled money and bought large blocks of stock to try to hold the market. It worked. For one afternoon. One afternoon. October 28th. Black Monday. The Dow dropped 13% in a single day. The bank consortium tried again. The market ignored them. October 29th, 1929. Black Tuesday. 16 million shares traded in one day. Some stocks had no buyers at any price. Around $14 billion of value gone in a single session. To put that in context, U.S. nominal GDP that year was $105 billion. They vaporized roughly 13% of the entire country's annual economic output in one Tuesday. People were screaming on the floor, "Sell, sell, sell!" But there was nobody left to sell to. And now here's the moment the story usually ends in most tellings. The crash, the drama, the numbers. But the crash wasn't the depression. This is the part that most people don't know. By November 13th, the Dow had bottomed at 198, half of its September peak. Rough, sure, but manageable. And then the market actually started to recover. By April 17th, 1930, the Dow had climbed back to 294, a 48% rebound off the lows. Investors who'd held their nerve were feeling cautiously optimistic. Hoover and Treasury Secretary Andrew Mellon were announcing that business was fundamentally sound and that prosperity was just around the corner. Sound familiar? Here's what was actually happening while the optimists were optimisting. Banks were failing. Not one or two, not a handful. In 1930 alone, 1,350 banks went down. In 1931, 2,294 banks failed, taking nearly $1.7 billion in deposits with them. Simultaneously, 28,285 businesses collapsed. That's 133 business failures per day. Every day, all year. And then came the moment that turned a bad recession into something unprecedented. May 11th, 1931. Kreditanstalt, Austria's biggest bank, representing 16% of the entire Austrian economy, collapsed. And because everything in the global financial system was connected by gold and obligation, the Bank of France, the National Bank of Belgium, the Netherlands Bank, and the Swiss National Bank all started running on American dollar reserves, which forced the Federal Reserve to raise interest rates from 1.5% all the way to 3.5% to protect the gold standard. They raised rates during a depression to protect a metal while their economy was collapsing. Here's a sentence that's hard to explain to anyone who hasn't studied this period. The Federal Reserve, committed to the gold standard, chose the standard over the survival of the economy. And while they were doing that, according to Milton Friedman's later research, they allowed the money supply to shrink by 1/3 between 1929 and 1933. 1/3 of all the money in circulation gone.
And the market kept falling. April 1930, 294. Then down, then further down, then further still. All the way to July 8th, 1932. The Dow Jones Industrial Average closed at 41.22. That is an 89% loss from peak to bottom in less than 3 years. And the Dow would not return to its September 1929 levels until November 23rd, 1954. 25 years. A quarter of a century. An entire generation just waiting to break even. Now, let's talk about what this actually meant for human beings. Because the numbers are abstract until they aren't. By 1933, unemployment had reached 25%. 1 in 4 Americans. 2 million people were homeless. Industrial production was half of what it had been in 1929. Farm income in 1933 was 1/3 of what it had been 4 years earlier. Farmers were receiving 2 cents per quart for milk. Corn sold for 8 cents per bushel. Hogs went for 2 cents per pound. Many farmers literally burned corn for fuel because they couldn't afford coal, and corn was worth less than the effort of selling it. From October 1929 to April 1933, the All Items Consumer Price Index fell 27.4%. Deflation so deep and so broad that essentially no category of goods failed to show price declines. All major CPI categories were lower in June 1933 than in June 1929. Chicago wheat dropped from $1.40 per bushel in July 1929 to 49 cents in 1931. A 66% collapse in 2 years. Then by 1933, the value of stock on the New York Stock Exchange was less than 1/5 of its 1929 peak. Less than 1/5. And U.S. nominal GDP? $105 billion in 1929. By 1932, $57 billion. They didn't just lose growth. They lost nearly half the economy. For working people, the racial gap made everything worse. The unskilled adult white male hourly wage was 45 cents. The black male wage? 35 cents. The 1939 median annual income for white men was $1,419. For black men, $619. The Depression didn't devastate everyone equally. It never does. So, the solution. June 16, 1933, President Roosevelt signed the Glass-Steagall Act, officially separating commercial banks from investment banks. No more using depositors' savings to gamble on the market. Commercial banks do commercial banking. Investment banks do investment banking. The wall between Main Street and Wall Street. And honestly, at the time, nobody even fought it. There was broad consensus that separation would lead to a healthier financial system. Of course it made sense. The system had just eaten itself. The law worked for 66 years. Then, on November 12, 1999, President Bill Clinton signed the Gramm-Leach-Bliley Act, officially declaring, in his own words, that the Glass-Steagall law is no longer appropriate. History's most predictable sequel.
The firewall came down. Commercial banks and investment banks could merge again. Insurance companies could get involved too. Full-service financial conglomerates, all under one roof, all growing larger and more interconnected. The bill passed the Senate 90-8. 90-8. Not controversial at all. 9 years later, 2008. Banks had bundled risky mortgage-backed securities, leveraged their balance sheets to degrees that would have made 1929 margin traders blush, and spread the risk so thoroughly through the global system that when one corner collapsed, everything connected to it collapsed with it. Lehman Brothers? Gone. Bear Stearns? Gone. AIG? Nearly gone. Merrill Lynch surviving only through a forced merger with Bank of America. The exact problem Glass-Steagall was designed to prevent happened again. Nobel laureate Joseph Stiglitz put it cleanly. When the repeal brought investment and commercial banks together, he said the investment bank culture came out on top. The conservative, deposit-protecting culture didn't win. The culture that chases yield won, as it always does when you remove the walls. Spoiler, the walls were there for a reason. We built them ourselves, out of wreckage. And here's the parallel that should keep you up at night. Not 2008. Something closer. Right now, as of 2024, U.S. federal debt stands at approximately 120% of GDP, over $36 trillion. For context, in 1929, federal debt was minimal. That fiscal space is what made the New Deal possible. FDR could spend because there was room to spend. That tool, that emergency lever, required fiscal headroom that had been preserved for decades. Today, the ratio has already surpassed the historic peak following World War II, and the Congressional Budget Office projects it rising to 116% by 2034, and potentially 172% of GDP by 2054. That's the baseline projection, not the disaster scenario, the baseline. So, the next time a 1929 scale crisis happens, the government reaches for the lever that saved the economy last time and finds the tank is already empty. Meanwhile, net issuance of speculative-grade bonds, unrated bonds, and leveraged loans was positive in Q4 2024. Private credit, the lending that happens outside the traditional regulatory perimeter, now represents about 9% of all non-financial corporate debt and is growing quickly. Harvard Business School research across 115 countries found that a single standard deviation increase in corporate credit to GDP is associated with a 3.6 percentage point rise in the probability of a financial crisis within 3 years. The 1920s version of this was commercial banks setting up securities affiliates, technically separate, practically identical, to sidestep the rules that weren't supposed to apply to them. Today's version is private credit funds, technically outside the banking system, practically woven into it. Different era, same trick. And somewhere, right now, someone with a very good suit and a very confident voice is explaining why this time, specifically, is fundamentally different from every other time. The technology's new.
The regulations are smarter. The models are better. We understand risk now. We've learned. Irving Fisher had a $10 million fortune and a Yale professorship and the most sophisticated economic models available in 1929. He told the world the plateau was permanent. Then he lost everything on the way down from the plateau he said didn't exist. The permanently high plateau became the permanent reminder that no plateau is permanent.
Here's what the research actually shows. Not opinion, not politics, just the documented pattern across centuries of financial history. Bubbles don't start because people are stupid. They start because the underlying conditions are genuinely good. The 1920s economy was actually producing things. Real growth, real productivity, real innovation. The problem wasn't that success was fake. The problem was that people borrowed against the future, as if the present would last forever. And when the present changed, as it always does, the debt stayed. The debt is always still there. The crash comes when creditors start worrying about whether debtors can actually pay. That's the trigger. Not bad news, not fraud, just a question. Can you pay this back? And when enough people ask that question simultaneously, the answer becomes a self-fulfilling prophecy. Nobody can pay back simultaneously. The music stops. The chairs are finite. Most people are still standing. Kindleberger documented this pattern across 4 centuries of bubbles. The sequence is almost identical every time. Revolutionary new thing, credit expands, prices rise, more credit, euphoria, someone asks the question, panic, collapse, denial, new regulations, eventual recovery, someone decides the new regulations are outdated, revolutionary new thing, and so on, and so on, and so on. The Dow Jones Industrial Average peaked on September 3rd, 1929, at 381.17 points. It closed at its lowest value of the 20th century, 41.22, on July 8, 1932, and it didn't return to 381.17 until November 23, 1954. 25 years. 2.5 decades. For a generation of Americans, their financial starting line was also their financial finish line. Treading water for a quarter century. And the people who designed the system that caused it, most of them were dead or retired by the time the index recovered. They didn't wait. They didn't pay. The waiting and the paying fell on everyone else. That's how it usually works. Money Never Learns made this video because these patterns don't stay in history books. They show up in headlines, in your retirement account, in the news story that seems confusing and distant right now, but will feel very close and very clear in about 18 months. Most people will watch this, think, that's dark, and go back to assuming their financial institutions have everything figured out. Which is fine. That's what most people have done in every era documented here. If you'd rather know what's coming before it's on the front page, you know where the subscribe button is. Irving Fisher knew the plateau was real. He just didn't know how high up actually was. Neither does anyone right now. Oh, nobody ever does.